right, hello and welcome to episode 2 of Hearth and Home. As always, I am joined by Coast.
Yeah, it is good to be back, but I thought we were going to do this weekly. What happened to that?
Well, we've had a bit of a changing life experience these past couple weeks. So, yeah, I can we'll hopefully get back to weekly here pretty soon. Won't we? Won't we?
Nice. Well done.
So today our topic is credit score, trying to figure out what it is, what it looks like, what you need to get a good loan, things like that. Moving from last time when we talked a little bit about how to save, how to budget, how to basically have a balance sheet month to month, understand where money is going and where it's coming in from. Usually the coming in from is pretty easy. Most of us probably have one, maybe two income sources at max, unless you're someone who's just like a serial entrepreneur and working in multiple different areas. But we are going to move now into what it looks like to get approved for a loan. And one of the first things that a lender will work with you on is credit score, understanding where you're at and where you need to be to get a good score.
So yeah, I've always just kind of wondered about this. So are you supposed to use like the FICO score, or like, what's the big deal with that? I don't fully understand that.
So that is a great question and a really good place to start. So one thing that's important to know is that FICO is not necessarily one that is used by mortgage lenders to determine your eligibility. But one thing that it can be useful in is there's a very public way of understanding how the FICO score breaks down. So seeing how they break down different pieces that create that consumer credit rating. So one of the big things is payment history. So 35% of your overall credit score for FICO is kind of made up by the payment history. Understanding, have you made payments on time? Do you have any missed payments on your record? Are there current missed payments that are latent? Things like that. And then you have amounts owed, which is around 30%. That digs into debt to income. So typically whether or not your debt to income is under the 43% marker. So if you're paying student loans, car loans, if you have another mortgage, different things like that, if all of those things combine and add up to more than 43% of your income, that's going to reflect negatively on your overall FICO score. And then length of credit. Have you had a credit card open for more than 6 months, a year, 2 years? The longer a card is open, the better that it helps the score in this area. And then new credit lines. Do you have a larger line available on your credit cards which show that you're responsible with a larger amount of money? And keeping that within a range and then balance wise on those larger credit lines. You don't want it to be like 90% maxed out. You want to keep it low. You want to have consistent payments on it, and you want to be able to show that you pay it off on time. And then just seeing a mix of different credits. So using a large MasterCard and then maybe something smaller like an Amex, American Express.
Okay, yeah, no, I'm hearing you. So, Dave Ramsey, big guy, went in the financing world. He talks about credit cards and basically kind of makes it seem like they're the devil. So, what is the relationship? Like, how should I kind of gauge that in this process?
Yeah, that's a really good question, and honestly, one that I've bumped into and thought of a lot over the past few years. And like, what's the better style? Utilizing leverage in financing versus just doing everything based on cash when you save up enough, and when you live a lifestyle. What the phrase I think is live like no one else, so that later you can live like no one else. So both, I think, sides have very good pieces to them, but when it comes to the whole chopping up the credit cards, that is adverse to your ability to get a good loan and good financing terms, because you need those long credit cards. You need to have a credit card that shows the history, that shows that you've been a good paying member of society for credit cards for quite a while. So while I think it's very noble.
Noble, you say? Go on.
Yes, noble. But as I was saying, Ultimately, in the end, it's actually going to hurt you not to keep those credit cards around and make just small payments, things that you would be paying off anyway, groceries, things like that, um, while not going beyond the allocated amount that you have in your budget, or, if you know just kind of in your head what kind of limit you have on certain items, not going over that, because there's definitely truth in the psychology of using a card just over and over and over and over again, and not realizing that if you did it if differently with cash, there's like this psychological pain that happens when you give away your ones, fives, tens, 20s, etc. So being careful of that, but just utilizing it as a tool, knowing that credit cards are a tool to get you better credit rating.
Okay, so doesn't like pulling credit hurt your score though, which kind of feels like oxymoronic a little bit. You have to hurt yourself to check yourself. I don't know if I fully understand that. So how does that work?
Yep. So when you go for an auto loan, every pull you make is going to ding you a little bit in your credit score. But with mortgages, how it works, as soon as you pull that hard pull the very first time with a lender, you might dip like 4 points, I believe is what it is. But then you have a 30-day window to work with other banks to see, who might give you the best possible rate. But a quick caveat, if you are doing a multiple bank search, multiple lenders trying to see who has the better rates, you want to do it as close together as possible, because the rates change so quickly that what you would be eligible for, that if you do it on day one and then another bank on day five, there could be like a quarter point hike or dip or something like that. And that's not because of the bank. That's because of the national bank and how it's affecting everybody's loaning potential. So something to keep in mind as you search around. Try to do it as close together as possible. But in terms of your credit score getting hurt, yep, 30 days you have, and it's only going to hurt you about 4 points.
All right, so I'm assuming with all of this, a better score equals a better rate, or another way of saying it is a higher score would equal a lower rate. Am I saying that right?
Yes, very good question. So instead of the FICO, mortgage lenders typically use what's called tri-merge. That means they're pulling from Equifax, Experian, and TransUnion. And typically about a score of 740 or above will get you the best possible financing terms for your loan. And then around every 20 points below that, you'll probably see some sort of effect on a higher interest rate rather than the lowest possible one you can get.
All right, so you said regular payments boost your score, right? So I imagine just everything you do day in, day out, that's regular, monthly, whatever, is going to help you out in this. Is that how it works?
Yes, definitely. Long-term payments over time, monthly, bi-weekly, whatever it is, make a very large impact on credit score. Now, one thing that is important to note though is not everything that you do your payments to monthly are going to show on a credit report. Typically, the things that are going to be strong are things like student loans, if you already have a mortgage, auto payments, things that typically aren't. Sometimes you will not see, most of the time I would say, you would not see rent. You would not see utilities. You'll not see internet, like kind of, I guess that's expanded utilities. So not only will you probably not see like the water, gas, heat, but you'll probably not see the internet, any sort of subscriptions that you have. Those things don't really help, which is unfortunate. But if you pay those things with a credit card, wimbo bambo, you get back to where you need to be. So that helps quite a bit. Having those long-term credit cards, that's going to be kind of the key thing that we talk about in this session. And I would say a lender would probably agree that if they're giving someone advice on how to fix their credit score, they would say start with a credit card, do your regular payments that you would be doing anyway, pay them off immediately, get that line of credit looking good. Another option for getting a quick boost, if you're kind of in that 600, little over, you want 40 to 60 points. If you have a mom or dad who has had a long-lasting credit card, you can have them add you as a joint borrower. And one nice thing is you will instantly be, well, I shouldn't say instant because it takes about 30 to 45 days to reflect, but you will be made a part of that borrowing history on that long time credit card. And that can be a really positive strategy that, low risk for the parents. They don't have to actually have you start spending on it, but now you are added to a card that shows long history of payments and payments on time. So if you're in a situation like that where mom or dad or spouse has a card that they've had 5-10 years plus, get yourself added, and that will immensely help get that small credit bump that you might be looking for. And like I said, about 30 to 45 days for that to show.
Okay, so let's say, I'm looking forward to buying a house. I want to go in right now. I realize my credit's low. How long does it take to start seeing like changes and effects in credit score for, some of these processes, whether I'm paying down my credit cards or, paying things off completely, making sure I don't have late payments? How long does it take? Am I going to be waiting a year until I'm able to do things, or is it a lot quicker?
Yeah, that's a really good question, because I think timing can be something that's very confusing for someone, especially if they're not really working with like a local lender. Typically, to see some of the things take effect, like paying off your credit cards, getting your late payments out of the way, things like that, you want to wait about 30 days to see that take effect. And I know we said earlier that you want to do credit pulls within 30 days, but this is something you'll see that 4 points drop off, go back. So you're really not losing a whole lot if you do it like 35 days later. Now, if you're serially doing it every 35 days, that probably doesn't look that great. But one thing, if you want to see the results of the work that you're doing, wait about 30 days. And then if you have pretty serious credit repair work to be done, so if you're under like 500 points or lower, you can use something like here in central Iowa, there's Heartland Credit Restore, and you can typically see a 3 to 6 month process to get that into that kind of 600, 640 range where you'd be more eligible for financing once again. That can cost around $200, so it is a little pricey. There are systems where you can get like a little bit of a bump. Maybe like if you're at 600, you want to get to 640. They have things in place that kind of help you move in that direction, especially if it's not something obvious. But most of the time, for the average person who doesn't have a whole lot of missed debt, or their debt isn't beyond that 43%, they're probably in a good credit range already.
Well, it definitely seems like this is a lot more arduous of a process than getting approved for a car, which, I would hope so, because it's, it could be 2, 3, 4, 5, 6, whatever, infinite times how much, maybe not infinite, but a lot more than the car loan. So it should be a lot more arduous.
Another important thing to note when it comes to thinking about DTI, or debt to income, is that student loans, if you're carrying them, let's say you have $100,000, even if you're in deferment, saying like, okay, well, the government's not actually making me pay a monthly balance because I'm deferred until the beginning of next year, or the couple of years from now. That doesn't matter when it comes to lending. The lender is going to look at that. They're going to look at the total value. So let's say it's $100,000. They're going to take 1% of it, so that'd be $1,000, and that would go into your debt to income. So even if you are in a place of deferment for student loans, just remember that will affect your DTI negatively, just naturally, because it's there. That's a part of your debt. That's the debt that you carry. So making sure that your debt to income is below 43%, that's going to be a huge part. So whatever you can do to kind of minimize that, to make it in a better range, that's going to have a profound effect. So that about covers it. So once again, if you have a trusted advisor, financial advisor, lender, especially lenders, talk to them about this process, because understanding what it's going to look like going into the beginning of the process to buy a home is really important, because the longer you wait to have that conversation, the longer it might be for you to start the processes that are going to qualify you for a loan. So thank you for joining us. We're excited to have you here. We just hope in the future we'll be pumping these out week by week. Life's been crazy, but we're very excited to continue on. So jam that like button, subscribe, comment. We'd love to talk more about what you're interested in. We'll see you next time.